Okay, good. Let's begin. Because of time, I'm saying it's almost 10:30. Yeah, we are around 4 participants. The rest will join us as we continue. So let's just begin. So my name is Victor. For those who don't know me, I'll be interacting with you guys for a while. Just a minute. So I'll be interacting with you for a while. And basically, I'd also love to know your input. Myself, I've been trading Forex at least for the last decade, since 2009 or 2010. And I introduced it to other people, and so far it's been good. So basically, yeah. So today we are going to start right away with the introduction to Forex trading. You can text your questions here. Text questions. Yeah. Okay, so let's begin. So for those, most of you who don't know what is Forex, so today I'm just going to give you a little bit introduction. This is what we'll be doing for the next 2 or 3 months. First, we need to understand what it is. How does it operate? So you've gone to a bureau, for example, or you've seen we are heading to the holiday season. And when we head to the holiday season, the foreigners will be coming to spend their money and basically enjoy for holiday vacation, Christmas and New Year. When they come in here, they'll be coming in with their dollars or their euros. And when they come in with their dollars or their euros, they cannot spend money in our country with that currency. They have to go back to the bureau. Bureau means they have to go back to the bank or the bureau at the airport to change the money. For them to spend or to spend money here, they have to change. The moment they make that exchange from the euro to the shilling or the dollar to the shilling, they take part in the Forex market, or basically they are participating in the Forex market. Another example, let me put it. Say you want to buy a car from here and you want to ship it from Japan. You have to go to the bank, exchange or negotiate a good rate with the dollar. Then from there, you're going to send your agent the other end who will be able to deliver your car. The moment you do that, you take part in the Forex market. Another example, we have exports. Exports like flowers, coffee, tea. We sell them to Europe, the US, and the rest. The moment we do that, the goods get there. Once they get there, they are received there. Now that's the flowers or the tea or coffee or the avocados, whatever it is, we send there. Then they will send the money to a bank account here in euros or in dollars. The moment they land here, there's an agent at the bank who will go back again to negotiate the rate between how much money that came in the account to exchange from the euro dollars to the shilling. Then, of course, the farmers, the middlemen, and everyone in the business is paid. So basically, Forex is a very, very, very big business. It revolves around us, all of us. Every time you wake up, every time you buy bread or milk, everywhere you're using money, just know somehow you're taking part in the Forex market. So let me introduce what it is. Number one, we have terminologies, long and short order types, and calculating profits and losses. What is professional trading? What is fundamental analysis? We will dwell a lot much on part 6. What is price action trading analysis? Price action, basically, I have a chart here for Euro USD. For example, this is just a demo I've been playing around with. So I'll be touching. I'm seeing some are still coming in. Kevin is in. Okay, continue. So this is Euro USD on 1 hour chart. As you can see, let me zoom it out. So you can see from here, it's been rising, came down. I got a buy here at 0.4. Let me put it this way. Okay, this is basically a terminal. We call it the MT4. You'll be seeing the prices. You can see the prices, bid and ask. Then here you can come. You can see I have a real account here and I have a demo. We have indicators, expert advisors, scripts, and the rest. So price action, basically what I was trying to put across is this price. Can you see this price? This price that's moving. Every time it moves up and down, that's what we are calling price action. So in the movement of moving up and down, so it moves from here to here, it's because we calculate them in terms of pip. Pip means price, just a minute. Yeah, pip. What does it, can anyone in the class tell me what's a pip? Anyone? I need you guys to be, what's a pip? Anyone answer me that? As we continue. So I'll also be doing introduction to Forex charting. I'll tell you what's a pip as we continue. Then what's a Forex trading strategy, common Forex trading mistakes and traps. This number 9 we'll be doing once we are able to get a strategy. And then once we get that strategy, because everyone needs at least, everyone needs at least a strategy for you to come on board, for you to be able to be profitable. You need first to understand yourself. You need to be able to win in your mind to be able to win in the markets. It's not the traditional way you're used to doing things, the way you went to school, campus, then finally you get a job. No, it's a whole different world. So common trading traps, what's a technical analysis? This one is also, we're gonna spend a lot of time there, how to make a trading plan. Now, and then after we have been able to learn technical, fundamental, sentiment, and even trading psychology, we have already shared the books in the WhatsApp group. If you're not on the WhatsApp group, kindly make sure you are added, because we'll be sharing a lot of materials, because eventually 75% accounts for psychology. Once you understand psychology, then you'll be able to win. Then the rest will be very easy. So for today was a little introduction. So let's just go what it is. So that at least we have a basic of what we'll be doing. So basically, and also this PDF was shared to you, all of you. So make sure you be referring to it. It will be our manual, or basically what we'll be using to be able to learn FX for the next 2-3 months. So basically, the Forex market is where banks, look at it, banks, businesses, governments, investors, and traders come to exchange and speculate on currencies. So everyone wants to come with a price. It's like when you go to buy that favorite shoe, or maybe what you love. You cannot just go and buy it on the shop. You have to bargain for the price. So that's why these guys are coming. Banks, businesses, government, they come to exchange and speculate on currencies. It is also referred to as FX market, currency market, foreign exchange currency market, or foreign currency market. And it's the largest and most liquid. Largest means by volume, the money that's moving or how much that is revolving around, it is the biggest. And then the most liquid, liquid means there's float. The way you use your M-Pesa, or the way you are able to use whatever you use, at least you need float. Float is money. When you have money in the pocket in M-Pesa, that is float. When money is circulating around the economy, that is liquid. If you out there and you cannot get a change of 500 shillings or 1,000, that means there isn't enough liquidity in the economy. But if you go to a place and you can be able to realize everyone can be able to get a change of 1,000 very easily, or everyone can be able to spend easily 5 or 10,000, that means that market is very, very liquid. So that's the meaning between liquid and illiquid market in the world, with an average turnover of 5.3. Although this rate has gone up right now, kindly mute your, so that the rest can be able to hear. Just what is joining. Okay, let's continue. So as I was saying, it's very big right now. It's around 6.3. This value has gone up. And also another beautiful, just a minute, guys are still joining. Admit. Also, another thing to note, it's usually open 24 hours a day, 5 days a week, with the most important trading centers being located in, number 1, London. London is the biggest financial center in the world. We also have New York, we have Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. And it should be noted that there is no central marketplace. So there's one thing people are not able to understand about their business. If I was asked out there in the streets or by a layman part, what do you do? I'll just tell them, I sell and exchange money for a living. And they'll be, no, how would that be possible? So let me help you explain how this works. There is no central marketplace for Forex trading. Instead, it's said to be conducted over the counter, OTC. It's not like stocks where there is a central marketplace where all orders are processed. For example, right now, if you want to buy stocks, you have to go to the Nairobi Stock Exchange, be able to open a CDS account, go get a broker, do this, finally get that stock and finally buy it. You have to technically, physically be there to do all that. But for FX, is an OTC. As long as you have an internet connection, wherever you are, you can be able to conduct the business. You can see I'm using my terminal here. This is MT4. You can be able to see what the Euro USD is doing right now. Then I can also even track, let me add these ones. I can track on a 24-hour period what the Euro USD is doing. So this is since midnight today, and this is up to midnight today. You can see they are called period separators. So I can be able to be knowing, are we falling or are we rising all the time? Sorry about that. And then let's continue. So it is a product. Now let's see what's the product. What is it that we are doing? Why should we spend? I hope everyone is in. Yeah, I think everyone is in. Good. Thank you, guys and ladies. What is a product? Product, it is a product quoted by all major banks, and not all banks have the exact same price. So what does that mean? If I come today morning, I will bid. Let me show you practically. Can you see this price here? 1.037. It is changing 716, and then we have the ask. So these are guys competing to get the best buying price. Ask is what they offer you. So when you come into the market, they first have to bid for you. They have to buy. They have to get the best buy price in the market, and then this is what they will offer you in the market. So this is now what we are getting. So you might get, for example, on the bid, we have 3 or 5 banks. We have Bank of America, we have JP Morgan, HSBC, we have probably Bank of England, and the rest. They're all bidding to give you the best price. So if you're always getting the best price, for example, look at this. If you are able to bid buy, and you are able to get this price from here, and you are able to roll with it, or you are able to swing with it from here to here, we make some nice profits. So these profits are what we are calling pips. And kindly someone tell me what's a pip by the end of the class. I hope we are following. So that's what we are saying. Then ask is what they offer you. And the difference, when I double click here, the difference between the two is called a spread. But these ones will be going into detail with them. You can see there's a red line, there's a blue line. The blue line is usually buy by the market, sell by the market. Buying by the market is when the price is going up, sell by the market is when the price is going down. So we are buying when the market is rising, we are selling when the market is falling. I hope you get that. Let's continue. Okay. Just a minute. Yeah, we were here. So we were at it's a product quoted by all major banks, and not all banks have the same exact price. Now the broker platforms takes all these feeds from the different banks and quotes. Okay, welcome. Basically, where are we? These feeds and quotes we see from our broker, from our press, it's an approximate average of them. It is a broker who is effectively transacting the trade and taking the other side, or make the market. So let me help you explain this, make the market. So there are times, let me go back to my chart. Can you see? This is, let me use a longer time frame, for example, D1. So you can see the market has been falling. Let me use weekly. But around here, you realize there is not much movement. Can you see this? And then around, okay, welcome, Emperor. Okay, there's also another place I want you to see around here. Yes. Can you see this region? So this region means we call it consolidation. After the market, just a minute, let me remove this. Yeah, like that, so that we can be able to see. Can you see the market fell? That was in February 2014. Then came to this point, and then at this point, you can see there was a lot of consolidation. So here, the buyers and the sellers are fighting. The buyers try to take the price up, the sellers take it down. The buyers try again, then the price is rejected by a spike. Then it goes down again. The sellers push it, the buyers are like, no way. So here, there is not much liquidity. So every time you buy or sell, let me go back to our chart. Every time you make a buy, someone else is selling. That is the only way we are able to have a balance in the market. Every time you're selling, someone else is buying. Let me explain it that. The moment I hit this button buy, someone else on the other end has to sell. The moment I sell this button, someone else has to. The reason why this happens is so that we can have an equilibrium. Equilibrium is in a way that every now and then the market is balanced. Let me explain. When the crash happened, let's go back to 2008. The chart is here. I'll be showing. Can you guys see this? And ladies, can you see this? This was when the 2008 crash happened. And I'll give you an assignment to go watch a movie on the same. So when this was happening, there was so much selling pressure that there are no buyers. So when this happened, the over 20 trillion USD was eroded here. And then around, say, 10 million people lost their jobs here. Can you see? This was the mortgage prime crisis. Okay, this one you'll understand. Go look for a movie called The Big Short. Let me write it here. Big Short. So that one will help explain what basically happened. So when that was happening, there was no equilibrium for us to be able to have guys who are buying. It was pure selling. You can see, and it's on a monthly. 1, 2, 3. Then around here, the government of the US tried to print $2 trillion. And you can see what happened. Jack, but then it was rejected. Jack, then the market went up again, then down again, then up again. It was forming a big W. Can you see? But then it was rejected. So look at this point. Can you see this was the lowest point? The market came, let me put this line so that you can understand. The market finally came and broke. It broke our price. What did it do? It went down again. Why did this happen? Because the moment the government printed here, money loses value. Every time they print, it has to lose value. So instead of the market going back, because it is not backed by anything, it has to be backed. At least the gold standard was where money was backed by gold. The dollar was backed by gold. So for us to know the value of dollar, we had to be, it was called the Bretton Woods system. But now when that happened, what happened? The market finally crossed here. And then that's why you see the euro has been losing consolidation. It tried to come back again to this zone, fell again, came back to this zone, and now finally fell. Right now is at its lowest. Can you see? Not really its lowest, but at least it's really, really, really low. So it's just an explanation I was making. Let's continue. So have the exact, so at least I've been able to help you understand what make the market for you mean. So when you buy a currency, your broker is selling it to you or not another trader. So the broker is very, very, very important for us to be able to be doing this business. Let's go to the retro history. So this might be boring, but I'll take maybe five minutes. So it might be boring, but let's have a look. But it's important to have some basic background knowledge of the history of the Forex market, so that you know a little about why it exists and how it got here. So how did we get here? Why are we here? Why are we here? Let's check. So here is the history. So in 1876, something called the Gold Exchange Standard was implemented. Basically, it said that all paper currency had to be backed by solid gold. So you see, the paper currency, the dollars, the euro, you know, mostly the dollar, we'll be using with the dollar right now. It had to be backed by solid gold. The idea here was to stabilize world currencies by pegging them to the price of gold. It was a good idea in theory, but in reality, it created boom-bust patterns, which ultimately led to the demise of gold. Why? Because there was not enough gold to be able to back this theory. So the gold standard was dropped around the beginning of World War II, as major European countries did not have enough gold to support all the currency they were printing to pay for the large military projects. So wars cost money. So they would not get enough gold. Sorry, I think my internet had gone down. Okay, let's continue. Okay, so we're almost done. Let me share my screen. So just give me a few of your minutes, then we'll be already done. So let's continue. So we were here. The gold standard was dropped during the beginning of World War II, as major European economies did not have enough gold to support all the currency they were printing to pay for the large. Although the gold standard was ultimately dropped, the precious metal never lost its spot as the ultimate form of monetary value. So why? I'll ask the class, why? Why did the gold, is gold still the ultimate monetary? This is for you to go research. It goes to the ultimate form of monetary value. Yeah, like that. You can ask questions. I know it's still our first class, but we'll also do a physical. We had promised you. So, but let's first do the theory. Then you understand a little bit of the practical and how this MT4 works, develop our strategy, the rest, then we'll be good to go. So let's continue. So this is the question I'm asking. Although the gold standard was ultimately dropped, the precious metal never lost its spot as the ultimate form of monetary value. Why? So that one you'll have to tell me why. So you have to have given you two assignment. What is a PIP and why is gold still the ultimate form of monetary value? I've texted the questions on the chat. So the world then decided to have a fixed exchange rate that resulted in the US dollar being the primary reserve currency. So right now they decided we don't want to do this system. This system whereby everything is pegged on gold and the paper currency is pegged on gold, we don't want it. It was called the gold standard. It was dropped. So let's see what happened. So when it was dropped, and it would be the only currency backed by gold. So they decided we won't do all the paper currency backed by gold. Let's only have a fixed exchange rate, that the dollar is the only one. The dollar is being the primary reserve currency. So now they decide the dollar is the only, oh, Sharon is in, she was out, okay. So the dollar being the only one that is the only currency backed by gold. It was called the Bretton Woods system, and it happened in 1944. Now it's getting excited. In 1971, the US declared that it would no longer exchange gold for dollars. Now this was the biggest mistake, because now this was the only ultimate form of monetary value. Number one, gold never loses its value. Over 10, 20, 100-year period of time, even 5,000 years old, time of Jesus, gold was still being used. They were being held in foreign reserves. So they said we would no longer want to exchange gold for US dollars that were held in foreign reserve. This marked the end of the Bretton Woods system. It was the breakdown of this system called the Bretton Woods that ultimately led to most global acceptance floating foreign exchange rates. 1976. Anyone tell me how many years is that? Oh, someone. Just a minute. Someone else needs to be in class. So 1976. So how old is Forex? 1976 till now. It's around 4 decades or 5 decades. But technically, it's almost 10 decades, 100 years, because internet was discovered in 1987. So around 1976, the Bretton Woods was basically dropped. And then this was effectively the birth of the current foreign currency. Oh, sorry, we need to mute. Let's mute her. Okay, let's continue. So although it did not become widely electronically traded until the 90s. The 90s, as I've told you, internet, 87, 88 is when the whole internet was discovered. MT4 was this platform was designed around 1995. 94, 95, this MT4. So after the internet was discovered. So what is it? At least we have had a history, the Bretton Woods, the gold standard. Now we have free floating exchange rates. These exchange rates we are having. These ones you can see here. These ones, USD Chef, GBP USD, USD CAD, and the rest and the rest. So what is it? It relates to retail traders like you and I. Now let's come to the real thing. What is it that we'll be doing? What is it that we'll be doing? Forex trading relates to retail traders like you and I. Is the speculation on the price of one currency against another. What all we are doing is speculating. Will the dollar do better than the pound? Will the euro do better than the dollar? How's the Japan economy faring? How's the geopolitics? How's the exports? How's the imports? All that. We take a country as our asset. For example, if you think the euro is going to rise against the dollar, if the economy of the euro is doing better than the US, here, that's what we are trying to say. You can buy the euro, USD currency pair low, and then hopefully sell it at a higher price to make a profit. Of course, if you buy the euro against the dollar and the US dollar strengthens. So now if I buy the euro, but now the dollar strengthens, you will be in a losing position. And of course, you'll be making a loss. So it's important to be aware of the risk involved in Forex trading and not only the reward. We usually have a mantra, understand your risk to reward ratio. What is your risk? How much pips will I risk? And how much reward will I want to be getting? So why is it so popular? So why should we be here? So being a Forex trader offers a great way to learn from the global economy than any other profession in the world, with potential probable great rewards. Not easy to get there, but if you're determined, disciplined, you can make it. So this is what you need. ability to take a loss without becoming in emotion. We will teach you how to trade. You can start with the demo and then continually upgrade to live. Confidence, you need to believe in yourself and your trading strategy. You need to have no fear. So we will need to take away all the fear that you have. To becoming the best Forex, you have to have dedication, discipline, remain calm and unemotional in a realm of constant temptation. That's the market. Then flexibility to trade and changing market conditionally. Focus, stay concentrated on your trading plan, not stray. Of course, logic, look at the market from an objective and straightforward perspective. Now, organization, forge and reinforce positive trading habits. Patience, to wait only on the highest probability trading strategies according to your plan. Realism, to not think you're going to get rich. So take a day at a time. Small, $10, $20, $30, $100, until the time now you're making good money. Be realistic. If you have small money, you have to risk kidogo. Survey, take advantage of your trading edge when it arises, and self-control to not overtrade or over average. Here we'll be teaching you much about risk management. So as traders, we can take advantage of the leverage and volatility of the Forex market by learning and mastering an effective Forex trading strategy. So today, we will be able to start mastering an effective Forex trading strategy, building an effective trading plan around that strategy. That's what else we'll be doing, and following it through with ice cold discipline. Very, very important. Money management will be key here. And leverage will be a double-edged sword and can make you a lot of money or lose you a lot of money very, very fast. I need you to see this. Can make you money fast or also lose money. So the key to money management in Forex trading is always knowing the exact dollar amount you have to risk before entering a trade and be totally okay with. So any trade you enter and you're okay with. So with losing that money, so we'll also teach you on how to put a stop loss in case you want to remove the emotional barrier, because one trade can be a winner or a loser. So more on money management later. So that's all for today. I was only giving you a small introduction. We should have the next class, I think on Wednesday. Maureen, you will confirm with the class on the WhatsApp group. So that now we'll start with the real thing, who trades and why. Now I'll enter you to this institutional. We'll also be able to learn who they are, what they do, governments, hedge funds, individual, all this. I need you to go read ahead. So that now from Wednesday, we can start doing the advantages. And then now I think we can be able also to start on technical analysis. Technical analysis will be from here. What are the terminologies and basically what it is. So I think that's for it. Unless we have any questions, I think I'm done for today. Any questions? Any question, participants? Any questions? Questions? I think we are still new. So I will stop it there and wish you a lovely day. We'll forward the recording to you. We'll forward the recording to you, then we continue. Please just avail, it's 1 hour or 20 minutes, 30 minutes. Then we'll be able to start on the practicals. Thank you so much and enjoy your day. For now, I'll say adios. Goodbye. My name is Victor. Have a profitable trading week. See ya. Okay. I think we're done.